Are you feeling trapped in your 30-year mortgage? If so, you're not alone. Most Americans feel the exact same way. Even if you have a low-rate mortgage, you feel like you hit the jackpot, but did you know that even if your interest rate was 3%, the first half of that 30-year mortgage, the predominant portion of that payment is going towards interest? It's almost like you're on a treadmill. Did you also know that most Americans don't ever pay off their home? That's why we have such skyrocketing rates of elderly still having mortgage payments today. There is a way out of that. And I'm going to talk about a strategy where you can pay your home off in as little as 5 to 7 years without changing your monthly budget. And I know it sounds too good to be true, but I've actually got proof here. I've actually got my cameraman, Derek, here, who has been listening to me for years and been recording me for years and has also executed on the strategy himself. So I wanted to bring him on and actually talk through how this strategy works and how best you can execute it and have the same results that he did. Derek, thanks for coming.
Absolutely, Michael. Thank you for having me and just allowing me to ask you some questions. And you're right, this strategy that you teach, it helped my wife and I pay our house off in just over 3 years, which has been game-changing for us. I wanted to just break that down today for our viewers as to how they can do this too. So basically, let's just dive right in. So how did you discover this problem that we're all overpaying so much on our mortgage? Why isn't this more well-known?
So I first discovered it, obviously, in the mortgage industry. I was an NMLS licensed loan officer for 17 plus years and technically still in the banking industry to this day and have a little bit of my hands on the pulse of the lending industry. And it wasn't until 2009, I had a hedge fund manager, a billionaire hedge fund manager that explained that I was basically a dope dealer, a financial dope dealer, and that mortgages are financial crack to middle America. The poor can't afford them and the rich don't use them. So obviously that stung quite a bit, and I wanted to dive into that. And honestly, I was just trying to get his approval. So I was looking for a way to disprove what he said and actually show him that I'm smarter, and now I'm eligible to be in your sphere of influence. So the more I investigated, the more I actually proved him right. He's correct. Obviously, I wasn't getting poor people approved for mortgages, but really I was more geared towards, well, what are the rich doing? What is it that they know that I don't know? So he was explaining to me how to use simple interest lines of credit and how we as Americans used to do that prior to 1913. So most people don't realize this, but a mortgage that we consume today is less than 100 years old. What we're going to be talking about today was predominantly how we financed real estate up until 1913. And we're really going to talk about it at a basic level so that everybody can understand this. And what's most important is so that everybody can execute on this.
Tell me a little bit more about what the problem with the mortgage is and when it comes to how we pay so much more interest.
So most people already know this. If anybody's ever owned a home and had a mortgage, that in the first 5 years, you're like, I didn't make a dent in what I originally borrowed. And the banks know this because most folks will move or sell every refinance or sell every 5 to 7 years. So the banks want to gobble up their profits first. So a mortgage is on an amortization schedule, and it's heavily weighted on the front end to pay predominantly interest. In fact, on a 30-year mortgage, you won't actually start paying more principal on that payment than interest until about 18 years in. So the first 5 years are not exactly interest only, but they're pretty close to being interest only because, again, they want to get those profits. Another thing is that people don't realize is that when you borrow money with an archaic death pledge like a mortgage, you're actually buying 2 homes. But guess whose home gets paid off first?
The bank.
Then you start working on paying off yours. So I really started investigating this and trying to figure out, is there an alternative? And is there a way that is mathematically more efficient and strategically more efficient to finance real estate?
Yeah.
And I settled on a home equity line of credit. And what is it? Really takes that pyramid and flips it on its head. And now you're in control. So when money goes in, it goes to principal first and interest last. On a mortgage, when you put money in, it goes to interest first and principal last. Again, because the banks have to make money. And hey, they're in business to make money. I totally get that. But us as consumers, we could be more educated to still use bank-friendly loans, but also something that's consumer-friendly.
Yep.
And that's what a home equity line of credit does for those that are qualified and can execute on the strategy, because it isn't for everybody. If you're not cash flow positive, meaning you make more money than you spend, really you're on a treadmill. This isn't going to help you. So if that's you can go ahead and cut off from here.
So you hinted on what the alternative to the mortgage is, Michael, that saves us in interest. Now, how does it work practically for this home equity line of credit to work? It was something that I actually had to wrap my brain around of thinking about the way I spend and receive my money differently rather than putting it all into a bank account, paying my bills, getting paid in that. I swap it all over to a HELOC. How does that work?
So one, we got to talk about sleeping money and active money. So a mortgage creates sleeping money because you can't put all of your money into a mortgage because you got to leave money left over to pay the gas, utilities, transportation, eating, all that stuff, right? So you got to have what we call an operating account to live off of. And so you can't put everything into a mortgage. So that money that you leave behind in a bank account, how much interest are you earning off of that? It's very little. It's like on a checking account, the national average is 0.24%. A savings account, the national average is 0.5%. It doesn't even keep up with the cost of inflation. So that money is actually slowly eroding, and we call that sleeping money. It's not active money because it's not actively doing anything for you other than just going backwards. However, with a home equity line of credit, because it's an open-end tool, money can move in and out freely, right? So if you put money in, within 5 minutes, you have access to that money. Let's talk about how you have access to it. You could have a credit card associated with the home equity line of credit. So you can use that at an ATM. You can use that at the grocery store. You got online bill pay. You can write checks. Essentially what we're doing is we are taking your home and your bank account and marrying them together. Everything that you can do in your checking account, you can do inside of a home equity line of credit, right? So now it gives us the comfort to put all of our money in, and when we utilize 100% of our cash flow, now we're waking that money up. It's either making us money or it's saving us money. So by putting it into the home equity line of credit, you suppress the balance, and a HELOC calculates interest entirely different than a mortgage does.
Okay.
So let's say you start off with 100 grand and you put 10 grand in.
So my direct deposit, for example,
It's a direct deposit.
It hits the HELOC. Rather than it going into my old checking account, I reroute it. So every month it goes into my HELOC account.
Yep.
And then boom, it drops it from, it was 100 grand, it drops at 10 grand.
Right. Now you're paying interest the next day on 90 grand. It's called per diem, daily interest. That's where HELOCs do what we call recasting every single day automatically for free. This is something mortgage companies will charge you to do with your mortgage. And you're only limited to do it twice if you have a mortgage company that even allows you to do it. Why is it so coveted and protected to keep consumers from doing that? Because it's a mathematical advantage for the consumer. But the home equity line of credit does that every single day automatically for free. So your balance drops, guess what? Your daily charges drop according to that balance. So now all of our money is going towards the principal, then interest is calculated. Where in a mortgage, your money goes in, it's going to interest first, then principal is calculated. It's an amortization schedule. So now the home equity line of credit becomes not only our home loan, it becomes what we operate out of. And so every single dollar, now we have the comfort to put every single dollar in there, knowing that we're liquid. We could use it for any expense that we want, but every dollar just got a job and went to work for you, either saving you money or making you money. And that's why it's so much more efficient.
So I've personally benefited from this. My wife and I paid off our home in just over 3 years.
Nice.
Which was awesome.
You beat me. Mine was 3.5.
Thank you. And so you've also helped other clients. Tell me about how many other clients have you helped?
Yes, thousands, 8,000. We keep saying 8,000, but that was probably a year ago. So now we're probably in the neighborhood of 10,000 plus clients. We've some rock stars, either people that, half of it off or even pay all of it off, but that's kind of where they stop. One in particular, there's a lot of them, but one specifically that comes to mind is Tyler. So if you got time, I'd love to show what Tyler has done, words right out of his own mouth.
Yeah, well, play it real quick for our audience.
Cool.
Take a listen.
So I stumbled upon Replacer University in June of 2020. And I remember being intrigued, and I thought at the beginning I was just getting in to pay my home off faster. At the time, we had technically years left in our mortgage, and I was paying a little extra in principal to get it down to 18 years. And when I met with Derek Waltz, he told me we could get it down to around 7 or 8 years with my numbers. So after some time of prayer with my wife, we decided to take that leap of faith, and we ended up joining as Replace Your Mortgage clients, and the rest was history. Honestly, it ended up being, times what I ever could have expected, and it probably sounds funny to say this, but it has been life-changing for us. We ended up paying our home off in full in October of 2023. So a little over 2.5 years, we paid it off way faster than originally expected, because when I became a member, I learned other strategies with insurance, investments, and leveraging, and becoming my own bank, and all sorts of other things that just really blessed my family. So I have told every friend and family I know about Replace Your Mortgage, and will forever, because it's not only been a blessing, but it's changed the trajectory of my family's life, and just given us so many new opportunities and freedom with our money, and helped us just get out of the rat race. So that's our story.
All right, so that was just Tyler. And a lot of other people. You got Edmund and all kinds of people. You see it on our website. We got tons of testimonials.
Yeah, amazing stories.
Yeah.
So Quick, now I want to go through what I'm going to call a lightning round.
Yeah.
So it's further questions that people may be wondering right now.
Yep. Does this mean I have to answer them lightning quick?
Let's try to keep them brief.
Okay.
So this is a scam.
We get that a lot. It's funny, even after all these years, 10 plus years in business, A plus, Better Business Bureau rating, we're not teaching something that's brand new. It may be new. At one point, it was new to you. You'd never heard of it, right? Because we're several generations removed to what this used to be as the normal. But again, we're just going back to basics. So no, this is not new. Home equity lines of credit have been around almost forever.
Right.
So we're just better utilizing a tool that's at our disposal. And you're in the know, then you already know, no, this has been around. This isn't new, nor is it a scam. Unfortunately, most that were in the know tended to be in the elite class, the millionaires. But this isn't an income tax bracket type product. Single moms that can execute on this. The biggest thing is you just got to be cash flow positive. You don't have to be a millionaire to know this stuff. So that's what we're passionate about, is not so much the millionaires. It's let's focus on hardworking blue collar Americans that are stressing and going through divorce, going through financial turmoil because they just don't know any better.
Yeah.
Those are the ones that we want to break free.
Yeah, and you hinted on it earlier about risks. Are there risks associated with a HELOC versus a mortgage? Tell me, I know there's a serious risk when it comes to mortgages that a lot of people aren't aware of.
Yes, so most folks aren't, and I've even personally witnessed this with a client of back in the mortgage days. It's called a mortgage acceleration clause. So if you've closed on a mortgage, you're signing a document that most loan officers or the closer or the notary that comes and helps you sign paperwork, that's not really explaining. They're just saying, hey, this is a mortgage acceleration clause, sign right here. And you sign and you flip over to the next page.
Yeah.
I encourage you to go get your mortgage disclosures. If you don't have them, you didn't save them, just call your title company up and say, hey, I closed 3-4 years ago. I'd like a copy of my disclosures, specifically to the mortgage acceleration clause. Okay. It's a scary document that people don't realize how scary it is. And essentially, it means that the lender can call your loan due almost for any reason at any time. And I actually witnessed that from a client back in the mortgage days. And he did nothing wrong. They just wanted it off their balance sheet. So that's scary. So it's because we're so accustomed to mortgages and we think they're safe. And then when we think about an alternative, they kind of paradigm shift and it's something that's not the norm, then we think we also automatically associate it with higher risk. It's actually not. When you understand the disclosures with a home equity line of credit and the flexibility that comes along with it, it's lower risk in a home equity line of credit than there is with a mortgage.
Wow.
Yeah.
Now, there are other risks like that for a HELOC, for example?
Yeah, there's similarities. It's called freezing, and there's forms of freezing. Let's say you had a $100,000 line of credit. I could freeze it down to 70. I could freeze it down to what you owe. I could freeze it down to what the value of the home is. So there's all kinds of ways that a bank will look at it to freeze it. But there's two scenarios in which they look to freeze. One, massive value reduction in your home value. So let's say your home's worth $500,000, and all of a sudden it's worth $250,000. That's pretty massive. I mean, you're about a 50% reduction in home value. Some of them even define it that specific, the 50% reduction in home value. There's some kind of nuclear waste that they've discovered in your backyard, or Al Qaeda set up camp in your backyard. I mean, it's going to come up for your value to go, especially in the times that we're in now.
I can't imagine values dropping that much.
In 2008, there were pockets that did that. Not a lot, not generally broad brushing across America. That was definitely not the case, but there was specific pockets where you could potentially see that. The second form is you just stop paying them. And that's really hard to do.
Hard to do because you mentioned earlier, it can pay itself.
You can pay them with their money.
Yeah.
Really hard to stop making payments to them. So again, I would rather have a HELOC in a recession than a mortgage in a recession.
Absolutely.
Yeah, and versa, even in great times.
So keeping the lightning round going, interest rates, in today's high interest rate environment, is it possible for this strategy to work even if, let's say, it's not a super low interest rate on a HELOC?
Yeah, you want to tackle where that comes from. You know, you're thinking like a consumer. You think, we ask the question, what is the interest rate?
Yeah.
And why are we, to ask our question, why are we even asking that? Because it's the lowest number, right?
Yeah.
So since if you had a 4% mortgage, there's a page in your disclosures called a loan estimate. It's 3 pages long. On the third page, it's going to tell you what you're really paying in interest. It's not the interest rate. The interest rate dictates the payment. Time balance dictates how much interest you actually pay. So on the third page, folks with a 4% mortgage are paying 60, 70% in interest. That's truly what your rate of interest is, right? Now, your interest rate dictates the payment. Your rate of interest dictates how much you're actually paying for that loan. Now, Derek, if I were to say, hey, Derek, I got this incredible product, it's a 30-year mortgage, and you're going to pay 60 to 70% in interest, where do you want to sign? What would you say? You would say, no, what are you talking about, 60 or 70%? That's what 99% of Americans are doing.
Let's say a loan, easy math, $500,000 loan house. I'm actually going to pay $1 million in that loan?
Yeah.
Or more.
Yeah. Yeah.
Hard to swallow.
I get it, but it's right out in your disclosures. So that's why we're taught to ask about interest rates, because we think that moves the needle.
Yeah.
Time and balance are far more important. So I'm not sidestepping the question. I want to answer it directly. Interest rates on HELOCs are competitive to mortgage rates. And in many cases, if you know where to look, they're substantially lower, right? Now, they compute interest differently. So I've seen anywhere from 0% to 9%. We obviously don't try to help our clients get 9% home equity lines of credit, because we still understand that is somewhat important. It's not the most important thing, time and balance is. So we still strive to get them a low rate home equity line of credit that outperforms their mortgage. But I'll share with you this. I would rather have a 9% HELOC than a 3% mortgage, because I will pay less interest on the 9% than I would the 3%. And I know that's a massive paradigm shift for you. With our strategy, we've never designed a plan where the total interest percentage is more than half what you would have paid on a mortgage. So let me repeat that again. We've never designed a plan where your total interest percentage is more than half of what you would have paid on a mortgage, which means with our strategy, without changing anything about your budget, but you do have to change where your cash goes, still maintaining liquidity, actually more liquidity and more flexibility than you would in a mortgage, you're going to pay a fraction of the interest that you otherwise would on a mortgage. Hence, you pay it off in 5 to 7 years on average.
That is such a value add, Michael. You're saying if I work with you, I will pay less than half less of what I would pay in the long run on interest. So tell me this, what are the requirements to get started with a HELOC?
Yeah, I recommend starting with a 700 credit score. It doesn't have to be perfect, it doesn't have to be great, but you need to be average, right? So 700 credit score and above. If you already have a home, I would prefer that you have 10% equity, right? Okay. So that means if you've got a home valued at $100,000, you only owe 90 on it, right? We can work with that. The important aspect, though, as I already mentioned, is you are cash flow positive. Yeah. You don't necessarily have to have mastered your budget, but you're not living paycheck to paycheck. Yeah. If you're living paycheck to paycheck and you have no funds left over at the end of each month, nothing's going to work for you, including the mortgage. Yeah. I have to share that with you too. I mean, you're not going to get ahead. So you need to figure that one out and somewhat look into your budget, find out where there's expenses that can be cut. You know me very well. Actually, in this day and age, I think it's just as easy to go create more money than it is to save money, depending on where you're at in your budget. But that is most important. If you are cash flow positive, we can work with that and we can make this work, and you'll pay a fraction of the interest you would on a HELOC than you would on a mortgage.
Which leads me to the question, tell me a little bit more about what your program is, Replace Your Mortgage.
One, we're going to give you the information, the knowledge, the education, and how to execute, okay? That confidence. Now you can speak the language, but we don't even have to understand the language, because what we've done is we walked through that jungle before you with a machete, and we've cut down the trees, making the path to walk behind us a lot easier and smoother. So we've investigated thousands of different banks and credit unions, and we've identified a couple hundred that make the most sense for our clients, that are consumer friendly and easy to execute on. So what we do is we hold your hand through the entire process. And most folks think that process, when they're on the outside looking in, that the process is done once you get the home equity line of credit. That's the beginning. That's when the fun really starts. Now let's start executing on a cash flow strategy, how to offset account, how to speed this thing up, how to identify opportunities, how to identify liabilities and assets. So that's the fun starts, is when you get your home equity line of credit, and then we continue to help you on from there.
Now, Michael, is there any type of guarantee you can offer me?
100%. So I don't want your money if you're not successful. And that's essentially what our guarantee is. If you come on board and you're not successful, then you don't pay us. We give you all of your money back. We don't want it. We want you to be successful. So with us, this isn't theoretical. This isn't just some digital product that, hey, take this and I hope that you're successful. It's no, we are with you to the end. We want you to be successful. And if we can't make you successful, then we didn't earn that payment and give it back to you.
This sounds great, Michael. So what does somebody need to do to take that next step to even learn more if this is a good fit for them?
It's real simple. We've got a link just below. We want you to click the demo button. And what that's going to do is it's going to ask you a little bit about your financial picture. We know something about you as much as we possibly can. You know, what does credit score look like? What does your financial picture look like? What are your hopes, dreams? What are your concerns? We want to know that. So it's a few short questions. Answer that. And then it's going to give you a calendar to book with one of our senior advisors. And then you're going to have a one-on-one consultation with that senior advisor. I want you to come prepared, knowing as much about your financial situation as possible, because that's the best way to get the most out of this. And here's the thing. One of the most valuable things that you're going to find out is how much you're overpaying, right? And we need to know that. As painful as it may be, we need to know how much you're actually overpaying. The exciting part is you're going to learn how quickly it can be completely gone without you changing anything about your current lifestyle. This is complete value add. There's nothing to lose by booking a free consultation. Everyone that books a consultation either walks away knowing that this is what they want to do, and we hope that's the majority of you, knowing this is what I want to do, and they take action and they get results quickly. Worst case scenario, you are now better informed about your own situation, and even if you're not a good fit, we're not just going to leave you hanging and say, sorry, we're not a good fit. We're going to give you homework. What does it look like over the next 3, 4, 6 months to maybe move things around to improve your financial picture that now you are a fit for us? So nobody loses value by doing that. It would be the best 45 minutes that you spent, I promise you, this year by having that one-on-one consultation. And again, if not, I will do the best. And God's got your back, and I'll do the best for you. I truly do, from person to person. But for those that are just kind of on the fence and thinking about this, you are here for a reason. You watched this video all the way up until this point. That wasn't by mistake. That was by design. And I just have a feeling that God's not only working with me, but he's also working with you to kind of together at the right time with the right message and the right need that you may have. And I promise you, we got the solution for that. We are the best in the industry at doing this, and we would love to help you. And again, if we can't help you, we don't want a penny.
Amazing. Thank you.
You're welcome.